Guys, let's bring in Scott Wren this morning, Senior Global Equity Strategist over at Wells Fargo Investment Institute. Talk about what the new year may bring. Scott, good to see you.
Hey, Carl.
I know you're also looking for better GDP and accelerating earnings, but can you get moderating inflation along with that?
I think you can, Carl, and we've got a 2.8% number out there next year for CPI, so that's, and that's not pretty much in line with where we are right now. But I think that, if we're wrong about that, you probably see inflation drift a little bit lower. And really, if I had to look out a few years, I would think it would drift a little bit lower, too. So I think that modest growth with moderate to moderating inflation, that's a good setup for risk assets. And that's really what we're looking for in 2026.
So is your playbook about adding risk at large or more rotating within areas of risk in equities?
We've done a little bit of both. I mean, we've tried to be patient here. We took advantage of the nice pullback we had in early April this year. We'd love to see another pullback, but it certainly really hasn't happened. And so the rotation thing, the way we've been playing that is we had been overweight infotech. We had been overweight communication services. Back in August, we went to a neutral on communication services, and we just recently, maybe about a month ago, went to a neutral on technology. So, that's about 50% of the total market cap of the S&P 500. So if you're just looking at those two sectors, I mean, you're carrying a load there at even weight. And we're trying to look at the AI trade in a little bit different way. We like industrials, we like utilities. Clearly somebody's got to build the data centers. Somebody has to upgrade the electrical grid. These utilities are going to see a real big surge in demand and probably some higher rates going forward. So we like those. And then we've also moved some money into financials. That's really our most favored sector. A lot of financing, M&A, deregulation, better economy. So we've made some adjustments and we've done a little bit of rotating. But I think we've got a 7,500 target out there for year-end 2026, and I think that's a really doable number in the type of economic environment that we expect.
Scott, it's been a strong year for stocks across the world. It's been a global bull market, if you will. Do you stick to the U.S. or do you look elsewhere?
Well, we had, for let's say the last 4 or 5 years, we had been really all U.S., but probably about a year ago, we were more neutral on developed international. We're neutral on the emerging markets. It's probably a cheaper way. The emerging markets are probably a little bit of a cheaper way to play technology and to play AI. But I think for us, really, if we had our druthers, we're sticking with larger cap, mid caps. We're sticking with U.S. over international. So we have exposure internationally, and we're certainly looking for opportunities to increase exposure there. But I don't think right now is the right time for that.
What do you think about what's going on in Japan right now?
Well, it's kind of funny. I used to be a currency trader. I traded a lot of dollar yen, and to be honest with you, I can't figure out why dollar yen's not 160 at least. But Japan, they're in a tough spot. They're in a demographic tough spot. They've tried to get inflation. They finally have it. I don't think they're going to raise rates too much, but certainly the talk of it didn't disturb the markets like it maybe would have a few months ago. So I think what's going on in Japan is interesting. We'll see if they can continue to grow and turn in a decent number. But I don't want to get overly focused on what the Bank of Japan does. I mean, they're dependent on exports. I'm more concerned about what the rest of the world is doing, which I think the rest of the world's going to do better next year relative to this year, and the U.S. is going to do better as well.